Most people think all brokers are basically the same. Zero commissions, free trades, modern apps. But I just moved my entire portfolio from Robinhood to Fidelity, and what I discovered shocked me. One platform was costing me hundreds of dollars a year in hidden ways I never noticed. The other was quietly making my money work harder without me lifting a finger. After 6 months of testing both with real money, I can tell you exactly why I made the switch and why it might be the smartest financial move you make this year. Here's what nobody tells you about choosing a broker. It's not about the flashy app interface or the gamified trading experience. It's about 3 critical things: where your uninvested cash goes, what happens when you need to leave, and whether the platform is designed to grow with you or keep you trapped in a beginner's box. I'll break down the real costs hiding in both platforms, expose the cash management trap that costs Robinhood users 3.59% annually, reveal the $100 exit fee most people don't discover until it's too late, and show you the exact math on when each platform makes sense. Understanding how these platforms make money explains everything about how they treat your cash. Robinhood pioneered zero commission trading back in 2013. They make money through payment for order flow, Robinhood Gold subscriptions at $5 per month, margin interest, and critically, the spread between what they pay you on cash and what they earn from banks. Fidelity has been around since 1946 with over $5 trillion under management. They earn from management fees on mutual funds, advisory services, and payment for order flow. But here's the difference. Fidelity genuinely wants you to invest more because that's their core business. Robinhood needs you to trade frequently and keep cash idle because that's where their revenue comes from. This brings us to the first major difference that costs real money: uninvested cash. With Robinhood, if you're not a gold member paying $5 monthly, your cash earns absolutely nothing. Zero. It just sits there while inflation eats away at it. If you upgrade to Robinhood Gold, you can opt into their brokerage cash sweep program that currently pays 3.5% APY as of November 5th, 2025. Your cash gets swept into FDIC-insured program banks. Here's the trap. You're paying $60 annually for that gold subscription to access what should be basic. If you keep less than $1,714 in uninvested cash, you're actually losing money on that subscription after accounting for interest earned. And that 3.5% rate fluctuates with Federal Reserve decisions and bank fees. Fidelity takes a completely different approach. Your uninvested cash automatically sweeps into SPAXX, the Fidelity Government Money Market Fund. As of November 20th, 2025, SPAXX yields 3.59% with no subscription fees, no account minimums, no monthly charges. Every single dollar earns from day one. You don't need to upgrade, opt in, or pay for access. Let me show you the real dollar impact. Say you keep $5,000 in uninvested cash while you wait for opportunities. With Robinhood's standard account, $0 earned annually. With Robinhood Gold, you pay $60 for the subscription, earn 3.5% on $5,000, which equals $175, net $115 annually. With Fidelity SPAXX at 3.59%, $179.50 earned with zero fees. Fidelity also offers their cash management account, technically a brokerage account that works like checking. It comes with a free debit card, unlimited ATM fee reimbursements worldwide, check writing, and bill pay. As of November 5th, 2025, it earns 2.21% APY with FDIC insurance up to $5 million through multiple partner banks. The second critical difference is margin rates. Robinhood Gold members get their first $1,000 of margin interest-free, which is genuinely valuable. Beyond that, as of October 30th, 2025, if you borrow up to $50,000, you pay 5.75% annually. Without Gold membership, Robinhood charges 6.75% on your entire margin balance. Fidelity's base margin rate as of October 31st, 2025 is 10.825%. For balances over $1 million, it drops to 7.75%. Most everyday investors pay more at Fidelity for margin than at Robinhood Gold. But here's what matters. Fidelity doesn't want you borrowing on margin. Robinhood's entire gold pitch centers on cheap margin access, which encourages leveraged trading that statistically loses money for most retail investors. The third major difference is investment selection. Robinhood offers stocks, ETFs, options, 22 cryptocurrencies, fractional shares, and American depository receipts. They added IRA accounts in 2022 with a 1% match for standard members or 3% match for gold members. That IRA match is genuinely industry-leading. Fidelity offers everything Robinhood does, plus mutual funds including their zero-expense ratio index funds, like FSROX and FNILX, bonds, certificates of deposit, Forex, and futures. They have traditional IRAs, Roth IRAs, SEP IRAs, simple IRAs, custodial accounts, 529 college savings plans, and health savings accounts. If you're building a complete financial life, Fidelity has the full toolkit. The research quality differs dramatically. Robinhood offers basic charts and company fundamentals. Gold members get Morningstar research reports and Level 2 market data. That Morningstar access alone costs $199 annually if purchased separately. Fidelity provides institutional-grade research from 20-plus providers, including Morningstar, Reuters, and Argus. You get detailed earnings estimates, analyst ratings, technical indicators, and customizable screeners at no cost. Active Trader Pro offers 129 technical indicators, 38 drawing tools, and real-time streaming data, all free. For charting, Fidelity offers 129 technical indicators versus Robinhood's 90. Fidelity has 38 drawing tools versus Robinhood's 26. Fidelity displays your historical trades on charts, shows corporate events, and runs automated technical analysis. Robinhood's charting is cleaner but less powerful. The fourth critical factor is fees beyond trading. Both platforms offer zero commission stock and ETF trades. Both charge 65 cents per options contract. Here's where it gets expensive. Robinhood charges $100 to transfer your account out using ACATS. $100 whether you're transferring $10,000 or $1 million in assets. Fidelity charges $0 for incoming transfers and often reimburses up to $75 of fees charged by your previous broker for transfers of $7,500 or more. That $100 exit fee signals everything. Robinhood makes it expensive to leave because they need to keep your assets. It's a lock-in fee disguised as administrative cost. If you want instant bank withdrawals from Robinhood, you pay 1.75% with a $1 minimum and $150 maximum. Standard withdrawals take up to 5 business days but are free. Fidelity offers free standard withdrawals without percentage-based fees. Customer service quality represents the fifth major difference. Robinhood offers 24/7 live chat and phone callback service. You can't directly call them, they have no physical branches. During high volatility events, Robinhood has historically suffered outages. Their reputation took a major hit during the GameStop trading frenzy in January 2021, when they restricted buying certain stocks. Fidelity operates roughly 200 investor centers nationwide, where you can meet representatives in person. They offer 24/7 phone support with direct dial numbers. They have a 79-year track record of operational stability. While no platform is outage-proof, Fidelity rarely experiences widespread technical failures. Platform reliability matters. Fidelity is privately held, has been profitable for decades, and manages trillions. They're regulated by the SEC and FINRA, with SIPC insurance up to $500,000. They have zero history of restricting trades based on volatility. Robinhood went public in July 2021. They faced a $45 million SEC settlement in 2020 for misleading customers. They paid $70 million to FINRA for systemic supervisory failures and technical outages. Both platforms are safe in that your assets are insured, but reliability and ethical track record favor Fidelity dramatically. Mobile experience differs significantly. Robinhood's app is genuinely beautiful. The interface is clean, intuitive, designed for one-handed phone use. Placing trades takes 3 taps. Everything feels game-like, which encourages frequent trading that statistically reduces returns. Fidelity's mobile app is more complex but increasingly polished. It feels designed by financial professionals rather than consumer app designers, which means there's a learning curve, but the functionality is deeper. You can analyze bonds, research mutual funds, set complex conditional orders, and access retirement planning tools from your phone. Let's talk about actual risks. Robinhood's biggest risk is the $100 exit fee locking you in. Their cash management requires a paid subscription to earn competitive rates. Their investment selection is limited. Their customer service lacks depth for complex situations. And their corporate history shows they'll restrict functionality when it suits their business interests. Robinhood's advantage is simplicity, low margin rates for Gold members, and the IRA match. If you're starting with under $5,000, trade occasionally, want a cryptocurrency access, and prefer streamlined mobile experience, Robinhood works fine. Just understand your trading sophistication for convenience. Fidelity's downsides: higher margin rates for most investors, more complex interface with steeper learning curve, comfy, and less handholding for absolute beginners. They don't offer as many cryptocurrencies. Their app still feels more corporate than consumer-friendly. Fidelity's advantages: automatic cash sweeps earning competitive yields with zero fees, comprehensive investment selection, institutional-grade research-free, strong customer service with physical locations, 79-year track record, no exit fees, and a platform that scales as your wealth grows. Here's my recommendation based on investor profiles. If you're a complete beginner with under $2,000, want cryptocurrency exposure, trade occasionally, and need maximum simplicity, Robinhood is defensible. Use the standard free account, not Gold. Don't use margin. If you have over $5,000 to invest, want your cash to work harder automatically, value comprehensive research, plan to hold investments long term, or need retirement accounts beyond just IRAs, choose Fidelity. If you're currently on Robinhood and wondering whether to switch, ask yourself, am I using features Robinhood excels at, like cheap margin or crypto trading? Or am I just keeping cash in a basic brokerage that earns nothing while Fidelity would automatically earn 3.59%? The math is straightforward. On $10,000 of uninvested cash, Fidelity earns you $359 annually, compared to zero with standard Robinhood. Over 10 years with compounding, that's nearly $3,900 just from cash management. Add in better research leading to better investment decisions, no exit fees, and access to the full range of investment vehicles. And the value becomes clear. I made the switch because I realized Robinhood had optimized their platform to keep me trading and keep my cash idle. Fidelity optimized their platform to help me build wealth systematically. My uninvested cash now earns automatically. My research quality improved dramatically. I have access to bonds for diversification and retirement account types Robinhood doesn't offer. And if I ever want to leave, there's no penalty. If you found this analysis valuable and want more deep dives into financial products that actually impact your returns, your engagement helped me decide what topics to investigate next. The bottom line: Robinhood works for crypto traders and absolute beginners who value simplicity above all else. Fidelity works for everyone building long-term wealth who wants their money working optimally at all times. The $100 exit fee and the 3.59% you're leaving on the table with uninvested cash at Robinhood add up to real money over time. Choose the platform that aligns with where your finances are heading, not just where they are today.